TraderMerlin show for your Tuesday afternoon edition. Now, yesterday we had a lot of discussion, or a lot of questions about a term called a Vega bomb. Now, a Vega bomb is used by one individual that teaches options. We shall not mention his name, but we'll talk about Vega today and explain the basics of Vega and some of the risk pieces and elements around it. Of course, here to help me make sense of it all, as you can see here in this wonderful graphic, we're talking Vega and Volatility with Corey Lane of TradersArmy. Corey, how you doing, my friend?
What is up, my friend? Man, I'm doing awesome.
Yeah, good.
You? It's good to see you, as always.
It's always good to be seen. I like being on the right side of the dirt, so good to have you with us. And by the way, and shout out to everybody. We got a pretty big group here joining us today. I see a lot of familiar names and new names as well, so welcome everybody. As we progress, feel free to type in your questions. What I would recommend, if it's directed at Corey or myself, put some question marks before your question. That way we know it's directed at us personally. And of course, if you are new, hit subscribe, hit that like button, whatever you want to do to help support the show. All right, Corey. The question came up, and I'm like, God, it's been a long time since I had Corey on the program. Let's talk to him, get his answer on it, because I am not a big options trader. I'm very basic, but you are a big options trader. Not in stature, but, you know, in the depth that you go into. So talk to me about Vega. Talk to me about the structure of Vega, why it's important, then we can talk about this quote-unquote Vega Crush.
Yeah, so in options, if you've studied options at all, anybody out there, you know that there's these things called the option Greeks. And it's usually where people get stumbled and kind of their mind gets all jumbled as far as like all these mechanics and moving parts. But it's really simply this. When you hold an option position, doesn't matter what the position is, you're going to be sensitive to movement when the stock moves. You're going to be sensitive as time goes by and sensitive when interest rates change, and your option is sensitive to volatility changes in the marketplace or expected volatility changes. And in order to understand how exposed you actually are, those are measured in the form of all the option Greeks: delta, vega, theta, and rho. And so Vega is the one that's associated with changes in volatility. And the volatility discussion can go pretty deep because there's historical volatility on the stock, and then there's the implied volatility on the options. What are the differences and what do we pay attention to? I'll start with the second question. What do we pay attention to? We always pay attention to implied volatility, which is the anticipated expected move or expected volatility on the stock itself. So if you anticipate a lot of volatility on the stock, then naturally the options will become more expensive. In kind of something that everybody's familiar with in the insurance world, if it's expected to be a fire-prone season or a high-risk hurricane season, or we just had an earthquake or tornado or whatever, your insurance premiums are going to be way higher because of all the anticipation or anxiety around the event, right? So, and that's important to an option trader because if you're not aware of volatility at all, or how sensitive your option is to volatility, many traders will get stuck buying an option that's grossly overpriced due to rising volatility, or selling an option that's grossly underpriced from a volatility that had, you know, declined over the past several days or weeks. So it's a very important conversation to have, and you want to understand that concept clearly before ever getting into options, because it's how you lose money and not know why.
Right, and I think that's the one that drives people nuts. And I've had that question many times in the 11, 12 years I've been doing these types of shows with Power Trading Radio and this one. And it's, man, I had the perfect trade. Everything was right. It did exactly what I thought it was going to do. So he's got his arms up in the air cheering like, yeah, nailed it. And you're like, wait a minute, how am I losing money?
Yeah.
And it ties right back to Vega. Well, it's a combination of Vega and delta and implied volatility.
Yeah. Oh, and theta, which is another time decay issue. But yeah, it's all those things. I mean, that's the thing with options is there's so many ways to make money, but there's also an equal amount of ways to lose money. And it sucks to lose money, but it sucks worse to lose money and not know why.
Right.
Right. And that's where options are really complex. Right.
So let's give an example. Like for one, we know when you deal with an IV crush, for example, generally it's going to be around a news-driven event. So that could be, a major economic announcement. We've got our whole omnibus. What's that new COVID variant thing?
Oh, the new Delta, yeah.
Or Oribus or some crazy thing. Just one other thing to scare us back into submission. But the majority of predictable events with regards to equities, it's easy. You got 4 times a year. They report earnings. It's on a calendar. They tell you if it's before market open or after market close. So you can start to see already volatility spiking. And I've already mentioned this to the viewers many times. I don't trade earnings announcements with options. It's not for me. I think it's too risky. I don't trade them, period, just because it's such an unknown. But you got to know going in that if you're thinking about buying an option as something is going into earnings, implied volatility is usually way off the charts, probably one of the 4 highest times it will be all year because of earnings. And if you're buying it, you're buying this overpriced item at that moment. So if all of a sudden the next day nothing could happen and price stays right where it's at, you may actually lose money because you paid too much for that option, right? That's the gist of it.
That's the gist. And I'll go so far as to say you won't maybe lose money. You'll definitely lose money if the stock doesn't move on earnings, but volatility will drop. That's pretty much a certainty.
Yeah.
So yeah, if you're going to be playing that event, you have to be entering that trade long before the anticipated volatility is even on anybody's or most people's radar. So we're talking 3 to 5 weeks in advance of that earnings event is when many times you could see volatility actually low enough to justify buying the option.
Right.
But as you mentioned, if you wait too long, you're basically paying for the expected move up front.
Yep.
So even if you get the expected move, like where's your profit potential? You know what I mean?
Yeah, absolutely. So a Vega Crush, I mean, obviously that's when you have just a massive decline. And I think you and I talked about this where it could actually go both ways. It's because you have such a quick, rapid change that they call it a Vega Crush. Want to walk us through kind of a to the upside or downside example?
Yeah, so the easiest one to predict is the downside crush, right? And you just mentioned it. 4 times a year, every publicly traded company has to announce their earnings, and especially companies that have a historical track record of moving big around earnings. Then if it has a historical track record of moving big around earnings, then the track record for implied volatility is that, yeah, you're going to anticipate that volatility is going to increase. Options are going to get really expensive going into the announcement. After the announcement happens, everybody knows the news. And then the anticipated future volatility on that stock is back down to normal. Mm-hmm. And so that's where you'll get volatility from an options volatility perspective, also known as implied volatility. That'll just fall off a cliff the next day because now the news is out. The anticipation is over. Everybody knows. And so that's the most predictable kind of volatility, right? And I guess you could have like index volatility, generally not quite as substantial in terms of rises and drops, but the indexes, SPY, Qs, Russell, things like that, Dow, on like major economic, announcements. Where you also see big crushes also is in like biotech companies and their FDA announcements.
Right, the missing approval or something.
That. Oh, yeah. I've seen 200-300 point rises and falls in volatility in a matter of weeks.
Wow, and you're on the wrong side of that one, you're toast.
You're toast if you're on the wrong side of that one, for sure. And so the easiest one is, around earnings, you get volatility crushing. But and there's ways to play that, for sure. I'm not going to say that there's not a fair amount of danger that goes along with that, because what you're anticipating is that if you go into an earnings event and the market is implying a $40 move on this $200 stock overnight due to earnings, and you say, okay, this is how much the market's anticipating the move to happen, $40 in either direction, that's what implied volatility is stating, and you go out and you try to capture really expensive option premiums by selling them just before earnings. Mm-hmm. Sell those options 50 points out of the money, above and below current price, because the implied volatility says it's anticipated to move 40 points. If you sell a 50-point wide series of options, you should be safe, theoretically, right?
Right, theoretically.
Theoretically. Until the stock moves bigger than even the market could anticipate. And I had a student do this. I was teaching years ago in Dallas. And I had a student set up, luckily, it was a spread trade. And these were credit spreads where you're selling an option and then you're buying a hedge, just in case it goes way further. And it was on Chipotle, Mexican Grill, and the market was anticipating Chipotle to move about 50, 60 points. So he sold options, $70 out of the money, thinking, I am really safe. I am 10 to 20 points further out than what implied volatility is anticipating. I think I'm going to be good. This is going to be a great trade. I just know it. That stock gapped 97 points overnight. $20 greater, $30 greater than the anticipated move, and certainly $20 greater than his short options. And so he took max loss on that position overnight, and there was nothing he could do about it.
Yeah.
And it was just a scenario. I mean, that's just one, example, but it's just a scenario of, yeah, you probably made money on Vega because volatility dropped, and you probably made a bunch of money on that. But the actual move on the stock itself cost you more in delta, and that's where the real danger is the market doesn't anticipate correctly, and the stock is way more volatile than anybody even anticipated. So there's a lot of danger in doing that, but for every one time that happens, maybe the other 4 times it doesn't gap that much. Right. And that volatility crush, that money goes into your pocket because you sold really expensive options. The market anticipated a highly volatile market. Earnings came out. The stock wasn't quite as volatile as everybody anticipated. Good news for the option seller. And then the options decline in value overnight, and you close the position the next day for all that Vega profitability.
How do you balance this out? Because you have, as an equities trader or a futures trader, a forex trader, hell, even crypto trader, I'm looking at certain price zones and I'm saying, okay, here's a strong supplier demand zone, maybe sprinkle on some indicators, whatever strategy or tactic I want to look at, and I can formulate an opinion and say, I have a good idea or I feel confident this is going to move in a specific direction. With options, I now have to not only do that analysis on the underlier, but now I've got to look at that option chain and go, okay, what's delta, what's theta, what's rho, what's Vega, what are these things telling me, and is there a hierarchy? Are there like boundaries, like upper and lower thresholds where you go, if it's at this level, I'm not even going to touch it. I mean, how do you walk that line with so many different choices and options? Because you do it effortlessly, I must say.
Well, thank you. I mean, that's only 16 years of being in front of a computer screen doing it every day. But it's not without practice that you don't get that fast at it, right? That's just really, really anything. But I'll say it 1,000 times, and 100,000 more if you give me a platform to say it. Every good option trade always starts with a good stock trade. So anytime you're looking at trading an option, it never starts with, let's analyze the option trade and let's analyze implied volatility first, and here's this event coming up. It first starts with, what is this stock chart telling me it's likely to do or not do, right? And of course, earnings is kind of, in some ways, all bets are off during earnings because, depending upon how bad they miss or whatever their guidance looks like in the conference call, or depending upon how much more money they make than even analysts anticipated, all bets are off when it comes to earnings. Now, there are many times where you can look at a supply area above or a demand area down below and say, man, this thing is anticipating a certain size drop or a certain size rise. That's what volatility is. And it just also happens that there's a demand area, in that same area. If the market's anticipating a 15-point drop and there's a demand area 15 points below current price, you can pretty well anticipate that the market's not going to exceed that level more times than not. And so that's more of I know the stock's probably going to move, but I don't think it's going to move bigger than this.
Right.
Because you've got supply and demand on your side, and then of course, then you stack implied volatility on that. As far as like how to gauge volatility and what strategy to use, it's a simple indicator like any other indicator. There's a volatility indicator that comes prepackaged with every trading platform.
But you guys customized your own.
We customized it, only because in the, when we talk about choosing strategies, when I first started 16 years ago, it was you had iVolatility.com. That was it. I don't remember that website, Merlin.
I'll bring it up.
And it was you had to go to the website and you had to look at the orange line of volatility and then you had to look at it and you basically break it up into 1/3, upper third, middle third, lower third. And it's like if that orange line is in the upper third, we employ these strategies. And if the orange line is in the lower third, we use these strategies. And if it's in the middle third, we use these. And it really doesn't need to get more complicated than that. And so, over the years, they started to code in implied volatility indicators into platforms. And then we had smarter people, than us customize that indicator to give us a plot. So it plots out the upper third, lower third, middle third. It's actually upper 20%, lower 20%, middle 60%. So we've refined it a little bit over the years, but it plots it out. So it's literally, if this black line is in the red area, use these strategies. If this black line is in the green area, use these. And if this black line is in the middle, use these strategies. And you don't really need to make it more complex than that. But what is really critical to understand, and I get this a lot in my trading sessions because I do 2 option trading rooms a week. And then, of course, when we do options classes, like, how do you just know, like, what's the perfect delta? What's the perfect Vega? What's the perfect theta? What's the perfect ratio of all of those things? And there's no black and white answer for that. But what's critical to understand is I'm going into this position thinking the stock is going to do this, thinking it's going to take this long to do it. So that's your delta consideration and your theta consideration. And based on where volatility is today, if I expect any change in volatility in the future, here's what I would expect. So if you expect the stock to go up, 12 days to go by, and volatility to go up from here, then you're going to have a strategy in your toolbox that says, I want a positive delta, positive theta, and positive Vega position. And having a strategy in your toolbox that says, that's the strategy that I can use to get all of those Greeks working in my favor, then that's where the magic starts to become connected between just a regular stock trader and a really advanced option trader.
Yeah.
And we have guidelines for all that stuff, like never trade a directional trade with less than 25 delta or greater than 40 delta. And we have reasons behind that.
Sure. Yeah, I know you've got all your rules. I think that's the question that came here. Kenny says, where can we find that do this strategy chart would be helpful even as a simple reminder. Well, I mean, that's obviously part of their content. You guys, Corey is part of TradersArmy School, and those are pieces that they give out in their, probably not going to give out in the show today, but he's given out a lot of content over the years, but those handouts I'm pretty sure are reserved.
Yeah, but it's really inexpensive to be a member, so.
That's true.
Then you'll get all that stuff, right?
Yeah.
Then you'll get all that stuff. Every option trading worksheet, every option trading on demand, every wealth essentials, and all that stuff. It's all included. But yes, we have worksheets and downloadables and things like that we give to our members and students. So yeah, absolutely.
Yeah, and yes, I was going to go to another piece here, which was, with regards to risk management with Vega, because again, sometimes it can be one of those pieces that blindsides people if they're not aware of it. If you're looking to mitigate or hedge that risk, there's a couple things you could do. I mean, if you're trading SPY options, you could use VIX options and buy a call on SPY and sell a put, and therefore you could offset the Vegas there. But you can also do spread trades. Is probably the most common way to not eliminate altogether. You can never say that statement to eliminate 100%, but to counterbalance. A positive Vega on one side, you could get a negative Vega on the other side, and that would help cancel out the Vega risk to your position, correct?
Yep, and that's the most effective way to trade it, because the first way you talked about is, you're trading options on SPY, but then you use options on the VIX to offset that risk. But those are two totally separate instruments that will have very different implied volatility measurements. So that's a more complex hedge, and it doesn't always work out in your favor, which is obviously you want something that's going to work out more often than not. And the easiest way to hedge that Vega risk away is to just use a spread trade.
Right.
And you can hedge away, like there are many trades that we build that you can hedge away, 30% of your delta, but 95% of your theta and your Vega. So now you're taking a strictly directional option trade without having to worry about the negative impact of theta or Vega if you're wrong on those two things. And that's where I would argue that you could almost spread trade 100% of the time, just simple vertical spreads, and that would be all that you really, really, truly need for your entire trading career.
Yeah, I think that when you do that, if you look at the spectrum of rates of return, when you go to spreads, I guess you would counter that and say, well, actually the rate of return can be higher, but you tend to not get the grand slams, right? If you go directional and you buy directional, you get grand slams. Usually with spread trades, you're not getting the grand slams. You're getting consistency and lowering the risk, which is also to some extent lowering your rate of return.
Well, it depends upon the option trade. So if you're talking about a simple vertical spread, you have a limitation as to how much you can lose and how much you can make. And that, return on investment is generally one that is still really, really healthy. But if you're comparing that to just buying a call or buying a put with, seemingly infinite profit potential, then yeah, that's where you could get a grand slam, because you do have that infinite profit potential, although I would argue that no one's ever going to get that, because most of us, as to treat trading as a professional business, you're going to have predetermined targets, and you're going to close out the position at that target anyway.
Right.
Now, there are some that we've been teaching and utilizing in some of the more recent, what I call my Options Plus course, called call and put ratio back spreads, which actually allow you to maintain, depending upon how much exposure you want to volatility, maintain a high delta exposure with infinite profit potential. And if you're dead wrong, you can still make money on the downside. Dead wrong.
Love being dead wrong and make money.
It's kind of like a straddle, but way better. And so it's really great for rising volatility markets. So not crushing volatility markets, but rising volatility markets. And so we use strategies like that before earnings, before anybody's even talking about it, anticipating a rise in volatility. And that's a great strategy to apply because you have infinite profit potential, so you can hit those grand slams. It's a positive theta position, so the longer the trade takes, depending upon where the price of the stock is, you'll make more money the longer it takes to move. And volatility rising, if you can anticipate that by looking at your volatility charts, then that's a really great trade because it is a spread trade without profit limitations.
All right.
Neat.
Yeah. All kinds of good stuff in there, buddy.
Should we get into that deeper, Merlin?
We can always go deeper into it. All right, so in this market environment, we've seen all of a sudden volatility spike because of some of these news announcements, because of COVID stuff. Anything change for you with regards to the options market? Anything interesting you see out there right now?
I mean, obviously, we're seeing a little bit more volatility overall in the market. So, but I don't think that should be a surprise to anybody who's really studying charts. Because we've been struggling to get into all-time highs for many of the markets. And finally, when the NASDAQ and the S&P made, all-time highs a couple weeks ago, it did it on weakening momentum, right? And I use MACD for that, but, a lot of people use different indicators, but it did it on weakening momentum. And so I was always kind of started to promote over the past few trading sessions, 3 to 4 trading sessions. Listen, I'm not saying the whole market's going to fall apart, but there's definitely evidence of the trend to the upside being kind of dead and weakening. And so it's okay to have bearish positions on, but still to this day, my portfolio is still net positive delta. It's still net bullish, but it feels like every week I'm adding one more bear call spread or one more short call or one more bear put spread. I'm just little by little hedging away a lot of that positive delta to kind of get not quite neutral, but we're starting to see evidence of some potential big declines around the corner, and the Qs are setting up for a real nice looking head and shoulders as of today.
Yeah, I got to actually have that one up there right now, just looking at it. And we talked about this a little bit over the past where, the market is still up. I mean, the trend is still up, but it's just showing a little bit of weakness right now. And you never know. That could potentially turn into a big downside move, if this Omicron thing steps up and really starts to wreak havoc on the financial markets and global community, then, yeah, we could go back into another big sell-off. I think personally, long overdue for a big significant correction, but I got burned pretty bad last year in a really aggressive play with puts, so I'm a little not shell shocked, but just like I'm not gonna jump in 420 puts again.
Was that your position size?
Yeah, my max was 420.
Oh,
Convenient.
wow.
I just stopped right at a nice stoner number, right?
Right at that stoner number, yeah.
Yeah, fortunately, it didn't work out.
Your position got baked, did it?
It did, yeah. That was about a 70 grand loss on that one, but it's like 68 somewhere in there. But it's one of those ones that if I was right and we'd have a double dip, it would have been a 7-figure gain. So well, you take a risk. It was all profit money anyway. So
it's all risk reward.
It is. So it's funny because I'm still selling puts and collecting premium, but we'll see, guys. If the market does start to roll over and start to make some new lows, and again, Corey mentioned you can see kind of the beginning forming. You got the right shoulder to go on this Nasdaq or the NQs for a head and shoulders pattern. Well, that might spook me out. You have the S&P right now. We made a new low today, at least for the past month or so, new low, and if we get down below, let's say 45.20. You could make the argument that we're starting to see some selling pressure and more downside movement is upon us. So maybe what we'll see is people starting to take some of their paper profits, which they're loaded up on right now, get some of that money off the table. But who knows? You just never know with these financial markets.
I know, and it was interesting to see the market 50% off its lows at the end of the day. So that's if you're bullish the market, that's a good sign.
Yeah, I'll bring up a shorter term time frame here. So guys, here's the Nasdaq, and while it was really aggressive to the south side in the morning, it recouped and actually ended on a pretty strong note. All right, it was on a nice uptrend going into the close on the Nasdaq. You can see S&P had a similar picture. The Russell, well, that's playing its own game, but still looked really strong going into the close there.
The Russell, man, it's just been like no for all year. Go clean your room. No.
It's been so weird. It's like I'm gonna play my own game while you guys just make higher highs, and it's funny because I have a chart which is full screen right now for the viewers at home, and it's got this yellow box that started back in January, and really it was violated just recently. We broke it to the upside on November 3rd. It went up for 4 days and then came right back down. And I'm almost about to put that yellow box back in place, but it's just been stuck there forever. Kind of comical.
It's stuck, yeah. That Russell's weird. It's been great for iron condors almost all year.
Yeah. Yep. Let me ask you, a question came in from Tom. Tom says, Corey, is there any downside to trading VIX options? I like the idea of swing trading it. I just took a bearish spread a couple of days ago. So downside to trading the VIX?
The VIX market can see you coming from 2 miles away. What I mean by that is if you're expecting volatility to rise because the VIX is low, and you're thinking, oh, I'm going to go buy calls or I'm going to go buy call spread, the market knows that everyone's thinking about that. And so they're going to price those options accordingly. Mm-hmm. Do you have an option chart, an option chain on the VIX, Merlin?
I don't. My option chain just all of a sudden they just stopped working, so I don't have that account.
I have it. I just didn't know if you had it.
No. I used to, but TradeStation's starting to be jerks with me, so.
Got it.
I'm jerks with them as well.
So I could share mine super quick. I don't have to share it for very long, but I just kind of want to point out, what to look for.
I always enjoy when you share your screen. I think the viewers love when you share your screen. Mine just looks ugly. Yours is like so refined.
I got to figure out here. I got a brand new 49-inch curved.
Oh, wow.
Yeah, and if I try to share that whole damn thing, it's going to be a mess.
Well, let's see. I think you can just share. So I see both of them. I see your
That's
YouTube.
the whole thing. Yeah. So can you see that, or is that just seems like it's going to be really wide?
It's really small. It's really
very
tiny.
hard to see.
Yeah, for my viewers, it's super small. It's like 1/4 of the screen.
All right, let me just do this then. How about that? That's just thinkorswim.
There. That's so nice. That's
Look
pretty.
at that. That's so pretty.
All right.
So the thing to watch out for is, we've seen volatility rise, from the low teens to, the mid 30s. Oh, sorry, the high 20s.
Mm-hmm.
So it's not going to be as prominent or obvious right this moment. But if you're looking at this, and you're saying, okay, we're up near all this, typical resistance, you would see volatility typically start to fall from here. And I think that's probably very obvious to even the most novice of trader who sees this ceiling as resistance. It's going to drop. This is your floor around 14, 15, 16. Volatility is going to rise from here. It always happens that way. And when you think you know what's going to happen and it's obvious to everyone, the market is not going to let you get away with that very easily. So what you'll normally see, and it's not as overly obvious right this moment, but if you're looking at the money option on the VIX, we're talking a 27 strike. Notice there's a little bit of a price discrepancy between the puts on the VIX and the calls on the VIX at the same strike price. And it's the puts that are more expensive than the calls. They're about 20% more expensive than the calls, largely due to demand for puts on the VIX.
Right.
Believing that, the VIX has to fall from here. And you might be right, but if you look at how much you're paying for those, you're paying for some of that expected move up front. So the market's going to charge you up front for what you think you know.
Damn that market.
Damn that market maker. And that's the biggest thing to watch out for when trading VIX options is just hey, how do I position this trade to not be exposed to market maker, shenanigans and overpricing puts or when you see the VIX down at 14, you'll see these puts at the money trading for like 60 cents. Wow. And you'll see the calls trading for like $3. It's ridiculous, the discrepancy in price, because they're like, yeah, everybody knows the VIX is going to rise. So let's just charge them out the ass for these calls.
You're going to pay for it, right? Yeah.
You're going to pay for it. And that's the thing. So that's the biggest thing to watch out for, Tom.
And I think that, again, it just goes back to the kind of the general discussion to start with, which was on Vega. And it's like, look, if you do the analysis on whatever it is that you're trading, you can see those, I'm not going to say outliers, but pieces being priced in, like we talk about, implied volatility being so high before an earnings announcement, or when you got VIX up at a higher level. These guys who are selling the options, they know the risk and they want a little bit of extra risk in their portfolio. It's just knowing what to look for and trying to put the odds in your favor, not the market maker's pockets.
Right. And one way to do that, if the options are really overpriced, is to spread trade. Mm-hmm. If you're buying an overpriced product and you want to hedge that, then sell an overpriced product at the same time. Right. And that's what a spread trade is, right? And that's how you can minimize that risk.
Sell overpriced products. Love it. Chris says, how do you use open interest in directional options trade? Does that impact you, open interest?
No. It's a common talking point. It's almost like, people assume that because there's a lot of open interest on one strike or a lot of open interest on multiple strikes, that there must be a directional bias associated with that. The problem with that school of thought is open interest is both the buyer and the seller have opened a contract at that price.
Right.
And they each have very different outlooks on that stock. A buyer of a call believes the stock will go up. A seller of the call believes the stock will not go up. And so if you just take that into consideration, you're like, okay, well, which of them initiated that transaction? Because, if you got a bunch of buyers of calls and you knew that they were all really wanting to desperately buy calls for a directional outlook that was up, yeah, that would be helpful.
Right.
But you don't know if the initiator was the buyer of those contracts or if the initiator was the seller of those contracts. You also don't know that if that person was selling a contract, are they selling that call option naked, meaning they really anticipate a neutral to bearish move in the stock? Or was that a part of a covered call where they're actually expecting the stock to rise and they're enhancing that with call premium? You also don't know that if the initiator was a buyer of the call and you thought, look, they're all buying calls. Right. That's true. But what if their portfolio is net negative delta and they're short everything? And this call option is just a hedge, just in case.
Yeah.
Like all of those factors, you will never know, ever.
You'd love to.
No. You'd love to know.
I would love to know that type of stuff. I mean, you kidding me? It's funny because even back in the days when I was trading equities on the floor out in Irvine, California, there was always this, oh, this transaction happened, that's got to be bullish. And like, well, wait a minute, every transaction's a buy and a sell. So I don't know who, was. I really want to know who's the institution, right? Because, no offense, but if it's I don't know. I was going to say, I don't want to put anybody's name out there. I was just going to throw somebody under the bus, but I've already tarnished this jerk from Chicago enough. But if this trader is selling an option and he's just a lowly trader who has a proven track record of losing money, and if he's buying it, I'd rather know the opposite side. I'd rather know who the one that sold it to him, because I want to go against that person, right? And unfortunately, we just don't know that information.
Well, and some of that can be seen in the implied volatility of those options as well. Right? So it's like, that if the volatility is really high, there's anticipated volatility on the stock, and what most novice traders are doing. Mm-hmm. They're buying the heck out of those options, because if everybody's talking about how big of a move Tesla can make, or Apple can make, or this stock can make, or that stock can make, then the best way to capitalize on that is to go buy an option.
Yep.
But if everybody's, buying options, if there's big demand for those options, you will see volatility rising. So, back to the question of open interest, I don't use open interest because I don't believe you can effectively use open interest to get the information you think you're getting. I simply use open interest as a way to gauge, are these options liquid enough for me to take big position sizes and not have a problem getting in or out?
Yeah.
With favorable pricing.
I agree. It's funny because years ago when I was learning options, I would actually look at open interest and say, wow, there's a huge block here. That must mean that's where price is going to stop or turn. And that's not necessarily true. So I stopped using the open interest from a, is it going to turn here perspective. But I do like it from a liquidity perspective.
In fact, there is an argument, Merlin, that suggests if you see a lot of open interest around one strike, you can almost anticipate, and there's a whole theory around this, where that stock is most likely to actually land at or near that strike, but not in the money, just out of the money, so that all those contracts expire worthless and the market never has to settle those options.
It's almost like it's a rigged game, Corey. Say it ain't so.
No, I didn't say that.
All right, we got to wrap it up here, but tell me a little bit about what you guys have going on over at TradersArmy. I know you have some specials. Someone was asking about your crypto program. Yeah, man, I'm promoting my competition right now. This is good.
Well, I told you, I've been trying to get you over here for a while, but you know how that goes.
Yeah, unfortunately, It is what it is. So tell me about what you got cooking, and you can probably stop sharing your screen now so we can see your mug.
Oh,
again.
I probably can. Yeah. Let me go ahead and stop doing that. So I mean, ultimately, we just launched a crypto class, and we got a free webinar tonight. It's about an hour, but it's really our instructor Herman Casas, who's kind of spearheading our whole crypto program, because I know very little about it. Chuck Fulkerson knows very little about it, and we are very upfront by that. So we'll be in the class tonight. I'm going to be in it more from a viewer standpoint, and I will be in the class later in the month. It does feel weird, Merlin, that we're offering a class that I know nothing about.
Yeah,
it does feel a little bit weird, but I'm super excited to get involved in it because I am very, very late to this game, and I'll tell you that.
But you're an expert in what you do. You got to respect that. But it's also, once you dive deeper into the crypto aspects, you will see that there's actually marketplaces where you can trade options. So you don't even have to necessarily trade crypto. You actually be trading options on decentralized marketplaces and have access to a whole different world of securities.
Yeah, and I'm excited to learn about all that. So that launches, our on-demand launches tomorrow, and then right now we still have all of our Black Friday stuff going on, so everything is 60% off, which is killer. And so we'll mention that in tonight's webinar as well. You'll still have an opportunity to get those, including all the option stuff as well for anybody interested, through tomorrow. I'm going to actually extend it. It was supposed to end today, but I'll extend it through tomorrow because of our webinar tonight.
Yeah,
but,
I have your webpage up there right now. Margaret says
okay.
Free is best. Not necessarily, Margaret. I have to disagree that free isn't best, but you
Not
should always
always
check
best.
out free.
Yeah. What's up, Gary? I see Gary just popped in there.
Hey,
What's
Gary.
up, man?
Yeah.
I see a lot of familiar names there. I'm watching this chat box in here too, which is great. I love the interaction. But
They've been kind of quiet today. They've been kind of quiet.
We got a lot of. So I got a whole new calendar that we're going to be putting together for all next year with all the options classes we're redoing again, and our futures trading class. And crypto's the one that we're excited about. But yeah, some cool stuff coming around the corner, and we're trying to promote that as much as we can and grow the community, which is awesome. Our community's just chock full of very just cool folks that like to kind of interact throughout the day, which is fun. It makes trading not so lonely.
Yeah, well, you've spent many years building a community over there, so congrats with that. And
Sure. Thanks, sir.
yeah, I appreciate you coming on and sharing some insights. That was the show was for Lisa, right? The show was for Lisa because she wanted to know about the Vega B word, but we're not going to use that one. It's just called a Vega Crush. We won't give attributions to the individual that came up with the.
Well, I don't even mind saying it, but it is not a
Industry term.
generalized. It's not an industry term,
Right.
So it's more of a proprietary thing, a proprietary term, and the school that was teaching that was very big on proprietary terminology, so I can't blame him for having it.
There you go. All right, Corey. Well, hey, thank you so much. I appreciate it. I sorry I didn't make it out to the kids' rock concert a week or two ago. I got to make it out to the next one. You got more of those coming up?
We do have some more coming up. We have just a short half-hour benefit show coming up next week. I don't even remember where that one is. Oh, Campus Jacks. I don't know where that is, but Campus Jacks. And then in Huntington, we're playing at Beer Garden. You know where that is, Merlin?
Wait, is that where you played last time?
Beer Garden. Well, the one that you came to last was in Irvine, right?
Yeah, it was like some really weird complex.
24. I was at Hangar 24. So this one's at like Beer Garden in Huntington. I could send you the info.
Yeah, send it to me.
But yeah, you're not too far. That
is it Beer Garden? All right. Yeah. Oh, you mean Old World?
Yes.
Oh, God! If anybody here is in SoCal and you haven't been to Old World, you got to go check it out. They actually tried to make it look like an old Bavarian town. So like you walk through the village and stuff. It's really cool. Are you gonna be playing polka music? I mean, what?
Not at all, man. It's a full rock show, man.
Cool. Hey, well, let me know. Send me the info on that one. I'll come down and check it out.
Will do, man. We'll hang.
All right.
And
hey,
I'm not running sound at that one, so I get to actually hang out at that one. The last one you were at, I was doing all the work.
Yeah, you're doing soundboards. Oh, that's crazy stuff. But you did well. All right, man. Well, hey, thank you so much. I appreciate you coming on at such a short notice. I'm sure my viewers appreciate it as well, as you can see. But thank you so much. Look forward to having you on again soon.
Anytime, man. Appreciate you guys. Thanks for having me on, Merlin.
Bye.
Be good.
All right, guys, that was Corey Lane of TradersArmy. He said he's got a Black Friday sale still going on. 60% off seems like a pretty damn good deal. You can go to TradersArmy.com, as I have here. A little window pops up. It says Black Friday sale. Show me. Click on that, and you get those deals. And I guess he's got a cryptocurrency program out there. I know when I saw Margaret saying free is a hint to you. Well, unfortunately, the one who's signing the employee or the payroll checks, they need to make money off the course. I have no input on the price of the program or whatever, but hey, I still think from a value perspective, it's worth every single penny of it. All right, but yeah, Corey talking options with us today, and I forgot Hernan is the guy doing the cryptocurrency program over there. You might want to check that one out. All right, that's going to do it for me. I need to go get ready for my crypto program. I've got a 2-hour session coming up here this evening. We'll still working on some topics for that one, but if you guys enjoyed Corey, do me a favor, give me a little thumbs up or a little subscribe channel out there, and I think that's going to do it. So if you guys have comments, questions, feedback, let me know. I didn't look up the economic calendar for tomorrow. I just haven't had time, but I guess I can do that for you guys right now, right before we wrap up the show. Today really was not a huge day. The Case-Shiller Composite 20 number that I mentioned, I was actually expecting it to be higher. Came out at 19.1. They're expecting 19.3. So all in all, everything was in line with expectations there. As far as Wednesday goes, there is some decent economic announcements. We have the ADP non-farm employment change, which right now jobs is going to be a major focus. You also have Powell be testifying. You have ISM numbers coming out tomorrow as well, construction spending, so a few good pieces of info. And earnings-wise, I think the only one noteworthy for tomorrow is Marvell Technologies, MRVL, but that's pretty much it. All right, that'll do it. Giselle, I will see you guys in 2 hours. That's absolutely, is it 2 hours from now? Well, 3, 4, 5. No, it's 6. It's at 6 p.m. You threw me off there. Don't scare me. All right, everybody. Again, if you have comments, questions, you want a topic covered, want me to bring on somebody specific, let me know. Email me at TraderMerlin@gmail.com. Until then, happy trading, everybody. I will see you manana. Take care.